Good day, students. Once again, I'll be recording this question on cost concepts, classification, and the behavior of cost. This is class exercise 9 that I have in my resources, and it says the following costs were incurred. Take note, they were incurred already in the manufacturing and the selling of champagne glasses during the past financial year. So this took place in the past financial year. They call it previous year. And the following costs were incurred, being depreciation on machine. And the depreciation on machine, they say on machines. Highlight that it's not one machine, it's machines. 15,000 rands was incurred. And the capacity per machine is 28,000 champagne glasses per annum. So now if it's 28,000 champagne glasses, that means that the machine cannot produce more than 28,000 units in the period of a year. That means this is the limit for one machine. In other words, if the company wants to manufacture more than 28,000 units of champagne in the period of a year, they will need another machine. And from the fact that they said depreciation on machines, it indicates that this 15,000 is for 2 machines or 3 machines or 4 machines that were used, meaning it's more than one machine that was used in the production of the units that were manufactured and sold during this period. Remember, we don't know how many units were manufactured yet, but we know that the machine cannot manufacture more than 28,000 units or one machine, meaning we'll need more than one machine if we want to manufacture more than what the one machine can manufacture, meaning more than the capacity. We are given direct wages 95,000, direct material 130,000, factory rent, which is a fixed cost. Remember, this is a variable cost. This is a variable cost. And we also know that direct material and direct wages are called prime cost. So also don't forget that these are called prime cost. And we are given variable selling cost of 45,000. Remember, selling cost, it is non-production related. It is non-production cost. When we speak of non-production cost, we also referring to the variable selling cost and also any other selling cost or admin cost. It has nothing to do with the production. Now we are further told that during the past financial year, remember the past financial year is the period that we are referring to, where all these costs were incurred. In other words, that is the past financial year we're talking about. And during this period, 28,000 units were manufactured and sold, meaning everything that was manufactured was all sold. And we manufactured 28,750. And 28,750 units, it is above the maximum capacity for one machine. That means we are, in other words, saying one machine, sorry for that. In other words, we are saying one machine is equal to 28,000 units. And if we need another machine, or if we need to manufacture more than that, we need another machine. And we know that we produced another 750, which is above the 28,000 of the maximum capacity. That is why now the 28,750 units of the production came into real. So now, in other words, we used 2 machines. One machine to produce 28,000. That one machine can manufacture over a period of a year. And we would have used another machine to produce the 750 units in order for us to produce the total that we produced of 28,750. Meaning, in other words, the depreciation on machines of 15,000 is the depreciation for 2 machines that were used to manufacture 28,750. So now, in other words, 15,000 divided by 2 will tell us how much is the depreciation for one machine. So now we say 15,000 divided by 2. so that we know that the depreciation for one machine is 7,500 rands. In the case where we produce only up to a maximum capacity of 28,000 units, but anything above that will require another machine, as it was in this scenario. Now we have captured this one very clearly. Very important to know how to calculate the step-up fixed cost. Now we are further told that selling price was 12 rand per unit, and now we are very clear with that effect that 28,000 required two machines. I want to highlight this because it's very important. 28,750 requires two machines, and the depreciation for one machine is 7,500. So now if we needed two machines, it would have been 7.5 to manufacture 28,000 and 7.5 to manufacture the 750, meaning this other portion. So now the total of 7.5 times 2 will give us the depreciation of 15,000 for two machines. So now the depreciation of 15,000 is the depreciation for two machines because the company produced more than the maximum capacity. So that's why now the depreciation is 15,000 rands. That means if the company can produce less than 28,000 units, then the company will only need a depreciation of 7,500 rands. In this case, the company needed or incurred 15,000 because they manufactured more than the capacity of one machine. So now we are very clear with that one. And we are then required now to determine the total cost, secondly the unit cost, and thirdly the profit if all prices remain unchanged at the following level of production activity or levels. Now we are told that we are to calculate the three requirements if we produce 25,000 units and we sell only 23,250 units. So now how to calculate the total cost, how to calculate the unit cost, and how to calculate the profit in the scenario A that we are given under requirement number 1. Now let us go straight to our first requirement. Now we know that our total cost is made of fixed cost plus variable cost. That is very first step to know. Total cost is made of fixed cost plus variable cost. And I also want to clarify the little bit of ambiguity in this statement. We are calculating first total production cost and unit cost for production, then after the profit, meaning this is total production cost only. We don't include non-production cost in this scenario, although it is not clearly stated. Now we first need to calculate our fixed cost and our variable cost per unit. Now our fixed cost equals 30,000 rands. Where is the 30,000 rands coming from? We are told that factory rent is 30,000 rands. It does not change. It is a fixed cost. There is no machine capacity there. Plus the depreciation of 7,500, which is 15,000 divided by 2. If you remember that one. Why am I taking 7.5 is because if the company produces 25,000 units, 25,000 units is less than the annual capacity, meaning the company will only need to use one machine. Why one machine? Because one machine can produce up to 28,000 units in the period of a year. So now in the previous scenario, once again, the company produced 28,750, meaning it produced above what one machine can produce, meaning above the maximum capacity for one machine in the period of a year. So now that is why in this previous case, when 28,750 units were manufactured, the company incurred double of the depreciation, meaning 15,000, because they would have used 2 machines. Therefore, now we divided here by 2 to say, if this is for 2 machines, how much is the depreciation for 1 machine? So that is why now it was 15,000, because 2 machines were used in the previous period. Now, in our current required information, we produce only 25,000 units, and 25,000 units will only need 1 machine, because 25,000 is below what 1 machine can manufacture. So now I hope we are very clear with that. That is why we say depreciation is 7,500, not 15,000, because 15,000 was for machines, meaning on 2 machines. And I think I've made that one very clear. So now our fixed cost will be 37,500. Now we need to calculate our variable cost per unit. It's very important to know that variable cost per unit are fixed. And we have our direct wages. Our direct wages, we have them as 95,000. 95,000, we divide this by 28,750 to get to our direct wages per unit. We also do have our direct material. Our direct material is 130,000. We divide this by the number of units that were manufactured as 28,750, so that we can get to our cost per unit. We have 95,000. I'll just show you these figures. I just remember 28,750. This gives us 3 rand 30 cents. This is our direct wages, meaning our variable wages per unit. Remember, variable costs per unit are fixed. Then we have 130,000 divided by 28,750. This gives us 4 rand 52 cents. Now they will be rounding off because I did not take all the decimals into consideration. 4 rand 52 cents plus 3 rand 30 cents. This gives us 7 rand 82 cents per unit. But I prefer the approach of taking the 2 totals, then after divide that by 1 total units. Our total variable cost, meaning labor and material, is 95,000 plus 130,000. It gives us 225,000. 225,000 divided by 28,750. Divide by 28,750. We get 7 rand 83 cents. Now there's a just slight difference. This is 82 cents because I rounded off here. I should have taken all the decimals, also here all the decimals. Now I'll take the more accurate one where I did not round off before the final answer. Now this will be the variable cost per unit, meaning the variable cost regarding direct material and direct wages. Now we are to calculate now our total cost. Total cost is equal to fixed cost of 37,500 plus our variable cost per unit of 7 rand 83 cents by the number of units that were manufactured in the current period. 25,000 units were manufactured. In the current period, we manufactured 25,000 units. So now we say 25,000 by 25,000 by 7 rand 83 cents. This gives us a total of 19. Let me just extend it just below so that I show all my workings. 37.5 plus 19,000 or 195,750 plus 37,500. This is 233,250. This is 233,250. This is the total cost that we were required to calculate. Now we have calculated our total cost, so we have responded straight to the first part of the question. Total cost is 233,250. Now that we have calculated our total cost, which is under number A, then now we need to go to the second part, which is the unit cost. Now our unit cost, once again, it is the cost per unit. We're calculating now our unit cost. These are just my workings, by the way. So now we're calculating our unit cost. Our unit cost is very straightforward. 233,250. Divide this by 25,000. This is our unit cost. Divide by the number of units that were manufactured. It gives us 9 rand 33 cents. This is our cost per unit. Then now we go to the third part of the question. Third part of the question is to calculate our profit. Very important, calculate our profit. Maybe these figures were not in your memory. Our wages were 95,000. There we have our material. It was 130,000. Our rent, it was 30,000. Remember, this is a non-production cost. So now it is not part and parcel of calculating the production cost that I was calculating. Here I was calculating total cost of production and also calculating unit production cost. Now we are calculating our profit. Remember, we are responding to what we are required to calculate. We are required to calculate our total cost, of which we have calculated our total cost. There we have our total cost first response. We are then required to calculate our unit cost, cost per unit of production. We calculated our cost per unit of production. There we do have it. Then now we are responding to the third part, our profit. We know that calculation of profit is very easy. It is sales minus cost of sales. In other words, we are doing income statement. And we say sales. And remember, our selling price remain unchanged. 23,250 is the number of units that were sold. They said that all other information remain unchanged, meaning the selling price is at 12 rand per unit. And they say all prices remain unchanged. And don't forget that they can tell you that the selling price may be increased by 10%. Therefore, now you'll have to increase that selling price by 10%, plus 10% there, before you can do your calculations. So we produced 25,000, we sold 23,250. Now we have our sales, meaning 12 rand by 23,250, which is 279,000 is our revenue. Then we say less cost of sales. Less cost of sales. Our cost of sales, we have our opening inventory. And we did not have any opening inventory in this scenario. Then we say plus production, meaning the number of units that were sold, or the cost of production. We know that the cost to produce one unit, meaning our unit cost now, the cost to produce one unit, meaning our unit cost, multiply this by the number of units that were manufactured, which is 25,000. It will obviously give us 233,250. But I need to make that one very clear. We have 9 rand 33 cents by 25,000. This will give us a total cost of 233,250. This is 233,250. Then this is our production cost minus closing inventory. Minus closing inventory. Remember, we produced 25,000 units. We sold 23,250. That means we are left with 1,750 units as closing inventory. And the cost of those units is 9 rand 33 cents. So we multiply this by 9 rand 33 cents, meaning the value of the closing inventory will be 16,327 rand 50 cents. This will be the value of the closing inventory. So now we say minus 233,250 this will give us the gross profit of 216,922 rand 50 cents. So now we say, sorry, this will give us the cost of sales, not the gross profit. Then we deduct our 279,000 of our revenue. This gives us gross profit of 62,077 rand 50 cents. This is our GP gross profit. I hope you understand my signs because my numbers were negative. I started from the bottom. In other words, you would have said 233,250 minus 106 163 27.50, which gives us 216,922.50. Then after you say sales minus this amount, 279,000 minus the cost of sales, you get to 620 or 62077.50. Then we need to less our selling cost. Remember, our selling cost is a variable cost. So now if our selling cost is a variable cost, remember selling cost is a non-production cost, so it must be after the gross profit. If it's a variable cost, we know that variable costs are fixed per unit. In total, they vary with the level of sales in this case because we are dealing with the selling cost. So now selling cost is connected with the units that are sold, not units manufactured, because it's a selling cost. Previously, all that was manufactured was all sold. So now we need to know how much was our selling cost in the past period. Then we use that selling cost in the current period. Why? Because variable costs are fixed. So now we need our variable selling cost, which will be 45,000 rands. Divide this by the number of units that were sold in the previous period, 28,750, and we'll see how much will have been our variable selling cost in the previous period. 45,000 divided by 28,750. This gives us 157 cents per unit of the previous period. So now we say variable costs per unit are fixed. So now this is fixed. We can use the same variable selling cost to multiply with the units that were sold in the current period. That's what variable cost being fixed means. It means the variable cost of the previous period can be multiplied with the units of the current period because it does not change, it remained fixed. So now we multiply this by 23,250. This will give us the variable selling cost for the current period, and it will be 36,391.30 cents. Then after we say minus 62077.5, this will give us a profit before tax of 25,686.20. So this gives us profit before tax that we are required. Profit before tax as 25,686.20. Now don't forget to show your calculations for the variable selling cost. Calculations are very important. 45,000 divided by 28,750 multiply by 23,250 units that were sold in the current period. That is the answer that you will get exactly. So now we have done requirement number 1, and we have touched base in all the 3 parts of the first part of this requirement, which is A. Then now we go to number B. Number B, we are told that 9,000 units are manufactured and sold. Remember, the introduction said that determine the total cost when 9,000 units are manufactured, determine the unit cost when 9,000 units are manufactured, and determine the profit when 9,000 units are manufactured and sold in all the scenarios, and sold and sold. But and sold only applies in the case of the calculation of the profit. Now, and they said in the following production levels, meaning when we produce 9,000 and sell all, when we produced 25,000 and sold only 23,250, and we are done with that one. So now we come to number B, calculating 1, 2, 3 when 9,000 units are manufactured and sold. First of all, if we manufacture 9.9 thousand units, we need to come to the step fixed cost, which is our depreciation. Now, how many machines do we need to manufacture 9,000 units? We only need one machine. Why one machine? Is because one machine can produce up to 28,000 units in the period of a year. So now if we are producing below 28,000, we only need one machine, and the depreciation for one machine is 7,500. And our factory rent does not change. Remember, factory rent is also our fixed cost. We have two fixed costs, depreciation and the factory rent. That means our fixed cost will remain unchanged, but our variable cost per unit will again remain unchanged, because we know that variable cost per unit are fixed. That means this variable cost of 9.33 cents in terms of our variable cost, direct material and direct labor, will remain unchanged, but in total it will change according to the number of units that are manufactured in that period, which is 9,000 in this case. So now we must calculate now our total cost in scenario number B. Now we are calculating our total cost. Total cost is equal to fixed cost plus variable cost. Our fixed cost remain unchanged at 37,500. Our variable cost, it is 9 rand 33 cents, and we multiply this cost by the number of units that were manufactured. In this case, we multiply this by 9,000 units. Let me verify, make sure that I make no mistake. We are calculating our total cost, which is made of fixed and variable. I want to make it very clear once again. Remember, our variable cost, we multiplied, we added those two, and we divided by 28,750, and it gave us the cost. This is the unit cost. No, this is the unit cost when 25,000 units were manufactured. So this is not where we are. We are looking for the, yes, this is the cost I'm talking about. Our variable cost per unit are fixed. This was our variable cost. This was the unit cost when 25,000 units were manufactured. So our variable cost per unit was 7.83 cents. Very important not to mess up with your numbers. So now we're 7.83 cents as our variable cost, 7.83. Remember, it was a total of 95,000. It was a total of 95,000 for wages and 130,000 for material, which gave us 225,000. I hope I still remember my figures. Yeah, it gave us 225,000 in total, and we divided by 28,750. So that is where this figure is coming from. It was 225,000. We divided by 28,750, and we said this is a variable cost of 7.83 cents. And remember, variable costs are fixed. Take note of that. Variable costs are fixed per unit. So we can use the same amount that does not change, and we multiply by the number of units that are manufactured in the current period. Current period, we manufactured 9,000 units. Now, even if you can use the variable cost for the previous period, when I'm saying previous period, you can calculate your total cost based on the 25,000 units, but I don't want to go there. It will be just a kind of dragging time. but you could still calculate your total cost based at this, and you divide by the units manufactured. It will still give you the same 7.83 rand. You first need to say that 7.83 rand multiplied by 25,000, and you divide by 25,000, you still get into the same figure, by the way. So now remember, variable cost per unit are fixed. So now we use the same amount that is fixed, we multiply by the units that were manufactured in the current period, so that we can get to know how much is our total variable cost plus fixed cost will give us total cost. So now we have 37,500 plus, and we say 7.83 rand by 9,000. This gives us 7,000 or 70,470 plus 37,500. This plus 37,500, it gives us 107,970. So now this is our total cost to manufacture 9,000 units. Fixed cost 37.5 is made of 30,000 and 7.5 of the depreciation for using one machine. Second part, we need to calculate cost per unit or unit cost. Unit cost, which is product cost per unit, it is 107,970 divided by 9,000 units. How many units were manufactured? 9,000. Now we divide by 9,000 units equals, it gives us 11.99 rand, which is definitely equivalent to 12 rand per unit. Now 11.99 rand, which is 12 rand, same as honestly as our selling price. So our cost of production and selling price are the same, and all the units that were manufactured and sold, all the units were manufactured and were also sold, meaning our gross profit will definitely be zero. So now we are now tapping into the last part of the question, the calculation of the profit. Now we are calculating our profit. Our profit will be our sales, and selling price being 12 rand, multiply this by the number of units that were sold. So it means we get to say 12 by 9,000, we get to 108,000. Then we have our cost of sales. In the case where everything manufactured was all sold, you don't have to worry. You can just say 9,000 because there's no opening inventory, there's no closing inventory. And we multiply this by 12 rand, it gets us into 0. So now this will be 108,000. 108,000. Our gross profit will be 0 rands. Remember, if you set 11 rand 0.99, it will be 0.0 something in terms of the gross profit, which is very close to 0. So now that is why it comes to 0. Then we less our selling cost. And now remember, selling cost, we said that it is a variable cost, and variable cost per unit are fixed. Let us check where did we calculate our selling cost, our selling cost. And I did not write down the amount of the selling cost in terms of per unit being fixed. Therefore now I can do that calculation in here in my calculation of profit. Now our selling cost will be, this will lead us into a loss, by the way. This will be 45,000. Divide this by the 28,750 units that were sold, and multiply this by 9,000 units, and this will be a total of negative 14,086 rand 96 cents. So now this becomes a loss before tax. Our loss before tax is 14,086 rand 96 cents. So now this is the last part of the response to this question. So guys, I hope you are very clear with all these calculations, and I want to make one very clear distinction only regarding the two income statements where I was dealing or calculating the profit. This is where I'm referring to going down. Here under the cost of sales, I only recorded one line, but in the previous one I said opening inventory. Let's change the color of the pen. I said opening inventory, and I said units, production cost, and closing, and it gave us that amount. Sometimes at the same time you don't need to do this. You can also have the same line as I did in this income statement of cost of sales, just one line. In this case, I under the production, I recorded all the units that were produced. Then obviously not all of them were sold, so hence there must be closing inventory. But if one wanted, you could have just recorded also one line by just saying how much the production cost. Production cost was 9 rand 33 cents. You multiply this by only the number of units that were sold, which is 23,250. And if you have done that, it was just going to give you exactly the cost of goods that were sold, after taking into account obviously what was left at the end of the year. Hence we only multiply by sales. 9.33 by 23,250, you see that you get 216,922.50. But I don't recommend this approach because when you go further with other income statements in cost accounting, you will be required to clearly show the opening balance, the production cost for the current year, and also the closing inventory. So now hence I'm showing you both of them. But at first year, you'll find that some lecturers will just only show the cost of sales in this manner, excluding production and also excluding the closing inventory. But at the end of the day, we get the same total. But please familiarize yourself with the opening, production, and closing inventory, because that is quite important, and it's also aligned with the financial accounting method of calculating income statement. With all of that, guys, you've been lovely listening audience, and I hope you are very clear and quite excited with this topic. God bless you. Go well. Thank you, guys.